fecha X. Y nosotros, para hablar de todo esto y mucho más, damos la bienvenida ya a nuestro invitado, Jay Pelosky, from TPW Advisory founder. How are you, Jay?
Very good. How are you?
Fine. Well, seeing this treasury saying that there will be some obligation, we will be able to pay post X date. Do you think they will get this solved soon, the debt deal ceiling?
Yes, I think so. It's disappointing that kind of the political gamesmanship has to get to this point where interest rates on U.S. government debt have gone up, particularly at the short end, considerably. So it's costing the American taxpayer a lot of money to go through these political games. But ultimately, I think that the debt ceiling will be raised and we'll be able to move past this. And I think that's what the markets are telling you, notwithstanding a little pullback yesterday, today. But if you look at almost any measure of risk or volatility, whether in stocks or in bonds, you know, there's really not a lot of risk exhibited in those indicators, which suggests that, you know, the mind of the market, which typically is way greater than, you know, any individual, is saying that it's going to get done. And that's our position as well.
Thank you, Jay. We'll see how this evolves. And yesterday we saw also PMIs in Europe and also in the United States. We saw a common movement. Manufacturing PMIs are again in contraction, at least in the USA for the S&P Global Flash PMI, while services are getting stronger. How we should read this PMI's story? The services going up while manufacturing is going down.
Yeah, I think it's clearly an indication of strong economies, or relatively strong. You know, you hear so much about recession and weak growth, but the PMI data, particularly if you look across the world, whether it's Europe, Japan, United States, China, the composite PMIs, which make up both the manufacturing and the services, are quite strong consistently across the globe. The US data, as you point out, was the strongest in 13 months. So that to us reaffirms and supports our thesis here at TPW Advisory that we are in an early cycle global recovery, not in a late cycle about to fall into a recession economy. And we believe that, for example, in the US, the two factors that really dragged down growth last year, housing and inventory destocking, are reversing this year. So housing has clearly bottomed. We've got some very good housing data just the other day. New home sales are up year over year. So housing has bottomed in the United States. You look at home builder stocks, they tell you that. And then we think we're about to shift from an inventory destocking to an inventory restocking. And that's going to lift the US manufacturing PMI, at least, we believe, back above 50 over the next several months. And so that to us is congruent with our view that we are, as I said, in an early cycle recovery, not in a late cycle about to go into recession.
Jay, and if we are entering this early cycle recovery, how this is going to affect investors? Like, for example, the stock market, we are seeing a nice movement during this first half of the year, and what to expect during the second half, yeah?
No, that's a great question, right? Because again, everyone talks about being in cash and being defensive, yet global equities are up 10% in the first 4 to 5 months of the year, which if you annualize that is a 20% plus return, which is extremely good. But yet no one talks about it. Everybody wants to talk about cash, which is up 1%, 1.5% year to date in the US versus 10 for 9 for the S&P, almost 20 for the tech stocks. The way we think things are going to play out, and we focus forward at TPW Advisory. So the way we think things are going to play out, we get through the debt ceiling. We have the Fed meet in June, less than 3 weeks from now. We think the Fed is going to be on hold, no more rate hikes. And we think more importantly than being on hold, they're going to raise their 2023 and 2024 GDP estimates. And that is going to send a signal to the market, to risk investors, that there is not going to be a recession. And therefore, you're going to see a rotation from the big tech, which has been the clear leader this year. The NASDAQ is in a new bull market. Again, something you don't hear very much about, but up 20% off the low of last fall. So a new bull market. And we think we're going to see a rotation from tech, which has been the leader, now needs to rest, to the cyclical parts of the economy, stock market. So home builders, transports, industrials, financials, those are the segments which we think are going to get a lift from the Fed raising its growth estimates. That rotation broadening out of the stock market will take the S&P above 4,200, above 4,300, and 4,300 is important because that is the new bull market for the S&P, 20% off the October low. And that brings in all the cash, all the defensive positioning that is out there, everyone negative, that's going to start to convert. We're already seeing it. You already see it in conversations, starting to convert the bears and the recessionistas into a more positive outlook, which will take markets higher.
Very interesting, Jay. So we keep an eye on these cyclical sectors and also on the 4,200 in the S&P. Thank you very much for your time, for your analysis. As always, it's a pleasure. Jay Pelosky from TPW Advisory founder.
Thank you very much. Appreciate it. Have a great day.